Good morning, everyone, and welcome to our May edition of our Mortgage Quality and Compliance webinar. I'm Susan Milazzo. I run the California MBA, and this is a presentation of our MQAC committee, so thank you for joining us today. Couple of announcements before we get started. Wanted to say that if you have received an invitation to join us today through a colleague, but you would like to be added to our email distribution list, feel free to send me your contact information. Susan@cmba.com is how to reach me, and I'll be happy to make sure that you receive these directly in the future. I want to give a big thank you to our 2021 MQAC committee sponsor, the Compliance Group. And today we have Jeff Flory to give us a little information about the Compliance Group and maybe a tip for our compliance officer today. So Jeff, take it away.
Thank you, Susan. I don't know if I have a tip. First, I wanted to give a shout out to Ray Schneitzeval and Carmela and wish them safe travels across Middle America. If you don't follow them on Facebook, they've been having some adventures so far. And if you do, you know exactly what I'm talking about. A little bit about the Compliance Group. We're actually celebrating 21st year serving clients nationwide in 3 core areas. Quality control is an outsourced solution for pre-funding, post-funding, and specialty project audits. Servicing QC to help you proactively monitor, identify, and address servicing compliance, and then broad-based compliance-related services such as audit prep, internal audit, AML, MERS, and federal and state-based file reviews. We're very proud to support the efforts of the California MBA, and in particular to sponsor the Mortgage Quality and Compliance Committee this year. This committee is just one of the ways that Susan and her team are working very diligently to promote advocacy amongst its members, to provide quality education and information to better inform our industry, and to help us all connect and collaborate as we continually strive to improve our respective organizations. So thanks for tuning today. And Susan, I'll turn it back to you.
Great, thank you, Jeff. So today's agenda I'll have up here for you. We're going to get into our presentations here in just a moment, but a couple of announcements. I am very pleased to say that we will be returning to in-person events, yay, in 2021. As being a people person, I'm ready to be back amongst my peeps, so I'm very happy to say that our Western Secondary Market Conference will be happening live and in person, August 24th through the 26th at the beautiful Monarch Beach Resort in Dana Point. We'll be opening registration for that conference on June 15th. So we'll be sending out some preliminary information as to how you can get registered, but that'll be happening here in the next couple of weeks. For those of you who might do any commercial lending, we also have our Western States Commercial Real Estate Finance Conference also happening in person, September 8th through the 10th at ARIA in Las Vegas. So my team is getting ready for both of those events, and we hope that you can join us. Also, we have a golf tournament that we're doing to support our Political Action Committee, CAMPAC. That's going to be happening at the Monarch Beach Resort on August 24th, which is also the first day of the Western Secondary Market Conference. You can visit our website for information on that, and that is now open for registration, but I will tell you, selling out quickly. I'd like to now move us to the next part of our agenda, which is our California legislative update. I'm welcoming our lobbyist, Pat Zenzela, to give us an update on just a few of the measures that we're following for the industry right now. Pat, I'll turn it over to you.
Thank you, Susan. So before I talk about the bills today, just to give you a sense for where we're at in the legislative process, we're moving towards the June 4th deadline for bills to pass out of their house of origin, and that obviously will cause there to be probably several hundred bills moving next week. We will see a lot of volume as far as moving from one house to the other. And then the legislature will be going on a break in July for a month for their summer recess. So a lot of activity going on. The first bill I want to talk about today is AB 13. You know, I have good news today on the bills that we're talking about, which is always nice to report to the members of the California MBA. First, with respect to automated decision systems, this is a bill that started out very problematic for the industry. It's specifically focused on state financial institution licensees, RMLAs, California finance lenders, state banks, et cetera, and would have required them to do an assessment of any of their automated decision systems. And the definition is very broad, so it literally would have covered any kind of software, anything that you're using to assess credit risk, et cetera, make mortgage decisions. And it would have been very problematic. You had to provide this assessment as far as potential discrimination of any of these systems, and then take steps to ensure that you have been able to remove any discriminatory impact, and then provide that information to the Department of Financial Protection and Innovation. It's been amended based on concerns of industry members to now only affect procurement contracts. So very similar provisions, but only impacting high-risk applications for entities that want to secure a procurement contract with the state. So much more limited impact, and with these changes, we believe that have minimal, if any, impact on California MBA members. The next bill I want to mention is AB 948. This is a bill that is coming out of some recent national stories on discrimination with respect to race, with respect to appraisals. Basically what the author is attempting to do here is to make sure that consumers, buyers of homes, folks that seek a mortgage to purchase a residence or a refi, receives information as to the fact that they're entitled to an unbiased appraisal of the property. And if they feel like there's some kind of bias, some kind of discriminatory bias with respect to their appraisal, provide the consumer with essentially a contact at the department, as far as state departments, and with respect to the mortgage lender to provide a complaint. So this is a bill we're working on with the author's office. We're trying to remove any duplicative disclosures and make sure that it'll actually work in the marketplace. And then finally, bill I want to mention is SB 449. This is a bill that would have, we're seeing quite a bit of this at the national level also and in various states, but would have required every financial institution to do an assessment as far as the climate risk on their business, and then provide that on an annual basis to the Department of Financial Protection and Innovation. We had a lot of concerns with this bill. It's gone through several amendments. It was significantly improved. As an example, the last set of amendments would have only impacted entities that have 500 million in revenue annually. But even with those changes, we still had concerns, and the author, based on the opposition, has not moved the bill this year, so he will not be moving the bill, and he has potential to revive it in 2022. So those are the bills I wanted to talk about, Susan.
Okay, all right, thank you, Pat. Yeah, the next few months between now and the end of August, or I guess the middle of September, will be really busy when session ends. So thank you for the update, Pat, and we'll be providing more information on future MQAC webinars. So thank you. Now I'd like to get us into today's presentation on MSAs and JVs. Our committee chair, Raymond Schneitzville, is actually participating in today's webinar, but he is, as Jeff had mentioned earlier, taking a fantastic trip across the country. Doesn't have great service right now, so he is listening in, and I'm going to fill in for him by introducing today's speakers. So we have Troy Garris, who's founder and managing partner of Garris Horn Law Firm. Troy deals with federal and state compliance, enforcement defense, company formation, and M&As. In these areas, Troy represents independent mortgage bankers, community banks, other depositories, home builders, and related entities. He's also currently co-chair of the Regulatory Compliance Committee of the Texas MBA, my good friend Lisa Bircher, and we are welcoming Troy to be one of today's speakers. Troy is joined by Paula Lieber, who is Vice President of Compliance and Licensing for CMG Financial. Paula enjoys filling this important role at CMG Financial that incorporates the three distinct origination channels their company has, which is retail, wholesale, and correspondent lending, and is licensed in all 50 states. Paula is also currently co-chair of our Mortgage Quality and Compliance Committee here for the California MBA. So thank you both for joining us today as our presenters. Oh, I advanced you too quick. I will turn it over to you two for today's presentation.
Thank you. And someday I'll get a professional photo. You have such a good one. Actually, Susan, will you go ahead and put up the first polling question? So we want to have some interaction today, and we have a very important first question for all of you. And on heart, are you wearing pajamas right now? No. 100% yes. Business on top, PJs on bottom. I literally took them off a minute ago. And Troy, I didn't ask you, are you business on top, PJs on bottom?
I am not. It's not my style. But I've seen some interesting videos of people that do that sort of thing.
Yes, for sure. I think we've all seen a lot of different choices of clothing on our Zoom calls.
I love Zoom.
We got a lot of no's, 83% no, 100% yes. I love the honesty, and then some business on top, more honesty, and I love it. At least one person literally took them off a minute ago. And Susan, will you go ahead and put up the first MSA question? We'll get started into our marketing service agreements. So how many MSAs does your company have? None, because you're smart and you don't want to have any risk at all. 1 to 5, 5 to 10, or 10 plus. Let's see, 0 and 1 to 5.
Interesting, about half and half too.
Yeah, and I'm sure on the 1 to 5, you're wondering, how am I going to stay compliant on our MSAs under the new administration? That's going to be a big one. And we have one more MSA polling question just to keep you guys interactive. On the scale of 1 to 5, 5 being the highest risk, how much regulatory risk is there in MSAs? I think it depends on the administration. I think I'd want to put 5 myself. But only if you're not documenting it correctly. It looks like quite a few of you agreed with my 5. And with some 4s, 3, 2, nobody said 1, which sounds about right.
I think that what that tells us is there are no production people on.
Yeah, that's a good point. The LS are going on. Okay, Troy, do you want to move forward to the next slide?
Sure thing. Okay, so thanks, Paula, and I do think that information is really helpful to see sort of what is going on in the audience in terms of what people are thinking about and doing. You know, I do think that from my own perspective, there is an increased interest in doing things with people in the purchase money side of the house as opposed to refi. And so more and more, you know, just recently, people have started asking again about MSAs and joint ventures and other ways to, you know, do some sort of arrangement with various possible parties that might be sending them business or could send them business, or, you know, that they can work with in a variety of different ways. So I think this is really a great topic. Plus, like you mentioned, the administration just changed. We still have an acting director over at CFPB, but you know, he's very active in his acting capacity, and he even mentioned he was on a Mortgage Bankers Association panel a couple of days ago, and he said, "Look, I'm not here to be a steward of the agency while you get the other guy confirmed. I'm doing things right now, and I have my mission, and we're pushing it forward." Now, my guess is that really there's a lot that is being guided by the likely incoming director as well, but you know, there's still a little bit of a separation there. But they seem very active, and probably will be, is my guess going forward.
Yeah.
So,
And a purchase business, like you said, is at the forefront right now. Refinances obviously went through a wonderful boom last year.
yeah,
We've got to get back to our purchase business, get back to working with those partners and doing it in the right manner.
right. And so there are definitely ways that you can do that. And the question is, how do you do it in a risk management, risk appetite sort of way that you're okay with? And again, you know, there's a bunch of different answers to that, because it depends in part whether are you senior management, are you production, are you compliance, are you something other, and all of those various interests come out differently, I think, on how much risk people are willing to tolerate and should be willing to tolerate. And of course, in these types of arrangements, RESPA Section 8, in particular 8A, we won't really delve into 8B much today, but 8A in particular, which is really just the anti-referral fee restriction boiled down, that becomes quite prominent. But I thought, because it's a good gating sort of item to level set on what Section 8A actually means, because sometimes we get wrapped up in the details, focused on the weeds, and forget what the actual provisions really are. And so 8A really it's a prohibition, first of all. So people frequently will ask and talk about, well, RESPA permits this and it permits that and so on. But really, RESPA doesn't permit anything. It prohibits certain conduct. And that's a good way to think about it, because when you're examining some of these different types of arrangements, the question really you should be asking yourself is, well, is this prohibited under Section 8? So I like to think of it from there. And I'll put it in a nutshell, and then I know you have some thoughts on this too, Paula, as to what some of this stuff means and the like. But boiled down, nobody can give or receive. So each violation arguably contains two violations, right? So it sort of spins out of to duplicating itself. But nobody can give or receive a thing of value, which can really be anything, right? You know, a lottery ticket can be a thing of value. Pursuant to some kind of an agreement, so there has to be an agreement. Doesn't have to be written, but it does have to be an agreement of some kind, that some kind of settlement service business related to a mortgage. The technical term is federally related mortgage, but that includes almost everything. So that some sort of settlement service business related to a mortgage is going to be referred to somebody, and it doesn't actually have to be referred to the person who is giving you the thing of value to be a violation. If I agree that you, Paula, if we agree rather that you'll pay me if I refer business to Susan, it's a violation. It doesn't have to be that I'm referring business to you. So it's a little more complicated than people think sometimes. But boiled down, that's it, right? Don't give anything of value to anybody who's referring settlement service business to anybody.
Yeah, and your LLs I mean, I'm sure they complain all the time. It doesn't make any sense. Why can't we do this? And, you know, I find it easier when you start off by saying, yes, it's kind of dumb. RESPA Section 8 basically defies business logic. Normal business is you have referral partners, you have people that you trust, that you work well with, and you refer business to each other, and you thank each other for that. But just not in our industry. So yes, loan officers, it's unfortunate, but this is where we are.
Yeah, and it's not just our industry, but it does affect our industry pretty heavily because of the nature of the way we do and like to do business, and the way customers like to do business. You know, I hear a lot of times, well, it doesn't harm the customer. That's always a question. But it really doesn't have much of anything to do with the analysis. The analysis is, are you giving something of value to somebody in exchange for a referral to somebody? And that's the way they look at it. Now, there are some exceptions to this to this prohibition, and we'll talk about those that are going to be meaningful here in particular. When the slide advances, there it goes. So a couple of exceptions in particular here that we'll talk about today. So the first one is you can pay fair market value for some sort of goods or services or facilities that, one, you actually need, because it got to be something of value to you. You pay fair market value for that, and also that and in addition, you have to actually receive it. So you have to need the particular item, and you have to actually get the particular item. And it can't be duplicative, but it can be something that you already have. But there's an exception for that. And included in that item that you actually need, you actually get, and you pay fair market value for, is kind of a subset, which is normal promotional and marketing type, educational type activities that may occur from time to time. So I can pay, I'll take it out of the context of the typical MSA, I can pay the Wall Street Journal to run an ad for me because I need that service. Probably wouldn't be where I would advertise, but I need that service. And so I can pay for that. I can pay fair market value for that advertisement in the Wall Street Journal. And so that's an exception to the prohibition on referral fees. In addition, I can pay my own employees for referring business to me. That's what LOs do, in fact. Their whole job is go out as an employee, find people that want to do a loan, and send that customer to the company. That's what they do. So you can pay your own employees. And then in addition, another exception is that you can refer business over to an affiliated business arrangement or a joint venture, as they're frequently called. And we'll get into some of those details here today as well. And then I like to talk about penalties, not because I get any joy out of it.
The riot picture.
Right? But I do think it's important to think about, what happens to people if they engage in these types of activities. What happens if you violate RESPA Section 8A or B, for that matter? Well, the first thing is there's treble damages that's built into the statute. So all of the settlement service fees that were collected, 3 times that can be applied as statutory damages under RESPA, and so that could be a pretty big penalty. And so that's the first one. That's just a traditional one that's built right into the statute way back in '74. In addition, it's a criminal statute. Now, not a lot of people wind up in RESPA jail probably, but there have been people over the course of time that have pled guilty to violations of RESPA, and each violation is, can be, you can get an application of up to $10,000 criminal fine and also a year in jail. So for people that are thinking of, is this really going to affect me? I mean, that it does have some real teeth in that sense. But I think the bigger part of this these days in particular is that the CFPB actions can be quite draconian, because the CFPB can come in and they can talk about civil money penalties of from $5,000 to $1 million per violation per day, actually, if they want to. They can talk about related persons. So if you are involved in a situation, even if it's the company that typically they're coming after, they sometimes do go after individuals. So senior management or owners or those types, if they find the conduct to be egregious and they dislike it vehemently. And then also we've seen situations where they ban people from the industry. So they can come in and they can tell you, not only are you going to pay all these civil money penalties, not only are you going to be individually penalized as well, but also we're going to kick you out of the industry either for life or for 5 years or for 1 year, whatever they decide to do in that sense. It can be pretty.
State regulators can do the same thing. I mean, you see state regulators do their own consent orders, and you can't have a license there for 5 years, 10 years, or never.
That's right. That's right.
And then of course you've got your own public image, and now the public doesn't trust you. They see your name. They now are going to tie it to that that issue that, because it would have come out, it's probably publicized somewhere. So you're going to have a loss of business and, bad public image. So ultimately, just make sure we do it right. So then we don't get there.
Yeah, you don't want them pulling back that hoodie on that guy and it being your company.
Yeah.
And I will say too that on the reputation side, it's not just reputation with customers, but also referral partners. I've seen a lot of cases where competitors will, after some kind of a consent decree or after some sort of an alleged violation. And by the way, the CFPB consent decrees don't always talk about what the facts actually are, because we represent a lot of people in these types of cases, and what is actually happening and what the CFPB is alleging can be vastly different. And it's just because people settle, right? The consent decree is really just a settlement. And the CFPB makes all these allegations. You don't really get to say, I didn't do that in public. So whatever they allege is what becomes the story in the public eye. And then competitors go around and say, is this the kind of guy you want to do business with? Why don't you come do business with us? We never got accused of violating all these rules. Yeah. So that's RESPA Section 8A in particular in a nutshell. So there's the general provisions, don't pay referral fees. There's the exceptions, you can pay fair market value for things you actually need and get, and the penalties that, and the ABA exception and the penalties that if you violate. So let's move on now to talk a little bit about what MSAs actually are. And Paula, I know that you've seen a lot of these over the course of time in the business as Vi. So you want to talk a little bit about what kinds of things you see out there?
Yeah, I mean, first off, it is a marketing service agreement, not a referral agreement. We're not, again, paying for referrals. We are paying for marketing and advertising. So we're paying for the ability to market to anyone in the public, not to anyone specific. So when you're a realtor and you have an MSA, as a realtor, you can have our signs up, you can have we could be on a website, we could be co-marketing, but we need to make it very clear that we're doing it to the whole public. It's paid, it's no specific advertising. The realtor's not sitting down with one person and saying, here, go to this company. This is who I'm endorsing. So again, it's really, we're paying for marketing services. And again, it could be your flyers, signs, website, could have big signage up out at their open houses. You could have, there's a lot of options that you can have for marketing and for how you advertise yourself.
And it's a good point, I think, that it's, marketing and advertising are related, but they're somewhat different too. And so I know that a lot of people will think of these as there's a fixed batch of rules and a fixed set of things that you can or can't do or should or shouldn't do. But in fact, if this really is marketing, there are lots of companies out there that, they're marketing companies or advertising agencies, and they do a lot of different types of things other than just throw up a banner ad on a website. And so even though most of the parties that are involved here, they're not themselves marketing companies, and they don't, that's not really their expertise and their specialty, I can imagine that there are a number of places that if they thought through it, they could come up with types of services and types of services that are actually needed and helpful that you can pay for. It's just that you need to think through that and make sure that it's something that you actually need if you're paying for it, something you actually get if you're paying for it, and that you're paying fair market value.
Yeah, which we talk about more on the next slide, in fact.
Yeah, let's get us to this next one here.
Yeah, about the risk. How do you have a marketing service agreement? Number one, we have down in the middle, clearly defined agreement. That agreement definitely needs to be clear. You need to list out exactly what marketing, what you're paying for. Are you paying for a sign? Are you paying for open houses? your flyers? Are you paying for that banner ad? All of that needs to be clearly defined. And I guess we kind of roll through some of these. I'm getting no payment for, can we say that enough? Did anyone get that? No payment for referrals?
Yeah, and in that regard, right, like you can have a referral and a service that's actually provided in the same type of an arrangement, frequently do. I'll use a very simple example to make the point. So let's say that I'm renting space from you, Paula. So we're talking about office rentals, not MSAs exactly, but let's say I'm renting space for you and you pay $20 a square foot to your landlord, and I get a little office in your shop, and I pay you $20 a square foot, or more, even better, I pay the landlord $20 a square foot. So I'm just paying exactly general market rent, same as you pay. Now I'm making a payment for a facility that I actually need and I'm actually using. Hopefully I'm in there, and that's not illegal. I'm paying fair market value for services needed or goods needed, facilities needed, right? But then you might also refer me business. I'm not paying for that referral. I'm paying exactly the amount that going market rent is. And just because I guess the footnote, because I'm a lawyer, the footnote is just because you're paying that amount doesn't mean that's general market rent. It's a good indication though. But you know, in the COVID world, maybe you're locked into a rate that's too high. Something to think about. But as a general matter, I'm paying for that office at the fair market value. If you refer me business, I can't give you an extra buck because you sent that over. I just can't. That would be, even though it's a tiny amount, yeah, I can't pay for that. So I think it's important to have those clearly defined agreements and not have that being payments for referrals, even if there are referrals involved.
And like you're saying with fair market value is that's a big piece of the MSAs. How do you determine the value of the different services? And one way is, I mean, you can try and do it yourself by looking around the market to find an average cost for each of the services. How much is the rent for an office in the area, or how much do signs cost, or the flyers and etc. Or you can use a third-party company like MLink, where they can do the valuation for you. I thought it was interesting. They have a web valuation that's pretty in-depth, where they can do counts of unique visitors to the website, so you know exactly how much business your advertisement on a website can be. Also for postings to Facebook and Instagram and the value of subscribers. Very interesting. Obviously that would cost more. But they also do standard valuations of the physical items, like your signs, your flyers, your office rental, all of those items. And that's a way to get your fair market value, because that is a big piece of what you're documenting. Is I am paying $20 for that office because, well, $20 per square foot, because that is the fair market value, and you will have to prove that. So that piece is very important.
I think that's right. I think also whenever the CFPB types, any regulator comes in and asks about these things, it's quite helpful to have this documented in a way that they ask the question, because they will. They'll say, do you have any marketing services agreements? And you know, you'll have to provide the information. And then if there's a good narrative that's been put together as to why this particular arrangement was entered into, and there's a good documentation about the value of those services, there's good documentation about that, you know, there's evidence that those services are actually being provided, not just, you know, you agree to get the services, the realtor, for example, agrees to do them, and then that's all there is, and you just send money. When you show that kind of information to a regulator, it really does ratchet down the tension in the conversation. And you know, typically regulators are looking for the obvious types of violations, flagrant violations, and there's plenty of them out there, so it's much easier for them to go after those types and operating kind of in the gray area.
Yeah. So I mean, if you're documenting, you're doing all the steps required, yeah, you're not the low-hanging fruit that they're going to want to go after. They're going to look for the example you gave that you have an MSA with the realtor, but the realtor's not doing anything on the agreement, but you're sending them the money. That's clearly what they're going to want to go after first. So always document, document, document.
Right.
And part of that is your reviews. You need to review the MSA. Do a monthly review. Are they doing what they said? Have them send pictures. And obviously, we can't necessarily go visit every location that often, but have them send pictures. Your signs are here. Your flyers are here. At the open house, we had your sign here. Whatever was in your service agreement, make sure that they're actually doing everything, and then save all that. Save it, because again, a regulator comes in, they're going to want to see your proof that you're monitoring and you're really only paying for those services you received.
Right. And that's actually a good point here. It's on the list as well, that you pay in arrears typically. So you have your agreement that's set up so that it says, you're going to do X, Y, and Z for me each month, and you're going to send me evidence that you actually did these things, and we've agreed up front how much that's going to be worth. And then once you send me the evidence, I'll send you the payment for the services that I've actually gotten. Because if you can't prove it, I can't pay you. I don't have evidence.
It's a good way also to get that proof. They may not be in a hurry to get you the proof because you already paid them. So
Right.
If you are not willing to pay until they've proven that they've done what's required, that's a great way to have that proof come promptly.
And it really helps them too, because like we said in the beginning, each RESPA violation is actually 2 violations.
Mm-hmm.
And when you give the money to them in violation, they're receiving the money in violation. And so it's not easy to get them to convince them that this is the case, because few realtors have gotten involved, have gotten tagged for this, although some have, with MSAs specifically. But it's it is a conversation you can have with it. I'm a good partner with you. I'm trying to keep you out of trouble. And you can point them to these couple of situations where realtors have, in the MSA context, been accused of paying really for referrals instead of for marketing services.
Yeah, and that's a great point. It's a good way for you to, when we are saying no, because we tend to say no a lot, we're trying to protect you. It's not just us not wanting to pay for something or get into this agreement. We want to make sure it's done the correct way, because we're not the only ones that will get in trouble if something happens. I mean, you will get in trouble too. So it's like you said, 2 sides.
That's right. And some other aspects of the marketing services agreements, and a lot of this, if not all of it, really, it's just an array of risks and factors. So we're not talking about, things that are clearly prohibited or clearly not prohibited. What we're really talking about is the kinds of things that the regulators look at whenever they come in and they talk to people about these agreements. And like we said in the beginning, with the new director coming in, with the new acting director there and the new director coming in, we anticipate, and he even said in the past couple of days that he's going to be looking at enforcement more than they believe the prior administration was looking into it. And they're bringing back cases that were already that they sort of turned off or started to let go a little bit or not look at very hard, and also bring some new ones. And so I think this is an area that, especially in light of the importance of this issue in the industry right now, I would anticipate that they're going to be looking at these pretty hard. But the endorsement factor, while not written anywhere in the context of MSAs, an endorsement, I think that this particular company is a great company, or this company does great service. Those types of statements to individuals, while they seem potentially on their face as if it's some kind of marketing or advertisement, or it's the kind of thing that advertisers do or that marketing does, it's a referral. A referral is just defined as any statement It can be oral, it can be written. Any statement that affirmatively influences the settlement service, the provider of the settlement service. So, or the choice of who to use. And so, any kind of endorsement is going to probably be a referral. Again, you can have a referral and you can have marketing in the same context. You can pay for the one, arguably, you can't pay for the other. But the endorsement really does raise some issues there.
Yeah, you have to be very careful about how you communicate, how you talk, how you do everything.
How you do everything.
Yeah.
Now, I can tell that this person in the picture here sitting at the top of the mountain, that's probably a compliance officer. She feels very lonely.
Hey, no, she's looking to the future.
Is she examining what's going on, or is she about to jump? I don't know. It depends on the time. Let's go on to JV.
Well, Susan, let's jump to
Oh, yeah.
our middle poll question, because we want to make sure you guys are still there. Do you multitask when attending a meeting online? Yes, I'm guilty. My mind tends to wander. No, I'm 100% focused. Well, sometimes. We thought this would be a good one right in the middle to grab your attention. Oh, yes, I'm guilty. And I do have to confess, I would have had to mark that one. I mean, obviously not today. And sometimes. Well, let's jump into the poll question for joint ventures. As we jump into our next topic, do you have joint ventures, and if yes, what type? No, yes, but primarily with real estate brokers. Yes, primarily with builders. Yes, with others. And the last one, what in the world is a JV? There is definitely a lot of talk about joint ventures coming up, and not everyone is aware of what they are because they went away for a while, but they've gotten more popular. So let's see, no joint ventures with real estate brokers, and yes with other. And what is a JV? Good. Well, we are going to help out with that.
So JV is junior varsity. And that's kind of what it is when you think about it. It's an arrangement where, in this case, we'll talk about lenders. Lenders are going and setting up, they're going to like a builder or a realtor, right? And they're setting up a separate company that's a small lender, or sometimes even a broker, but brokers are a little more risky. We'll talk about that a little bit. But that's why I say it's junior varsity, is you're setting up a small competitor of yourself. And it's a brand new company. It's licensed on its own. It has, instead of being owned by whoever owns your lender, it's owned partly by the lender and partly by some other party, typically. And it's a full-fledged company. And there are a lot of these out there, and there are a lot of people that are asking about this at the moment. In fact, I think it's a pretty safe way if you actually take the time and effort to invest in setting up this type of an arrangement. From a legal perspective, it's a pretty safe way to develop business with a partner like a realtor or a builder. But there are a lot of risks and there are a lot of complications, and even though it might be safer from a legal perspective, again, you have to do it right. It comes with the downside of you have a business partner now, and so business partnerships, some are great, some are not so great, and a lot of them are in the middle. And it comes with, you got to think through both of those aspects of it.
Yeah, and like you said, it's a new company. You have to consider you're creating a new company. Do you even know how to create a new company? You're definitely going to need legal assistance to make sure that you have your articles of organization, your service agreements, your everything really buttoned down. And then as a lender, you need to get licensed. So you're going to be licensing as a brand new company. It's not it's not easy. None of it's easy. And there's, so many pieces to consider that goes into having a whole company. But you do definitely have to remember it is a separate company. It is its own company, and it needs to be treated that way.
Yeah, and it often is a company that has, like most startups, it has kind of a small beginning, but the idea would be that over time, especially, that it will grow into a full-fledged lender. And even if it's a broker, again, there's a little more risky, but whatever type of company it is, it should look, feel, talk, walk like any other company out there. It shouldn't be really a company that is just there for the purpose of, which is what the regulator will say, it's just for the purpose of funneling referral fees over to the other partner. So let's talk a little bit about some of the ways to mitigate risk on this. There's a bit of a lag, so I'm.
Well, I was going to mention some of the licensing pieces to consider is there is a lot of upfront costs. First, you've got your setup with legal, you're setting up your company, then you need to get licensed. And all of that is all happening before you're ever going to start a loan. You're also setting up your systems and access and preparing to hire people, and all of that's happening before you're making a dime. So there's a lot that goes into it, and it's not easy to get company licenses, especially since the pandemic. It's quite difficult, and there's very long timelines depending on what state. And like you said, you have a business partner. When you go to that business partner and say, we're going to start this new company together, great, so we can start in a month. No. You really have to set expectations and then keep your business partner happy as you work towards being able to actually start the company. It does take a long time.
Yeah, there's a significant ramp up, and the conversation's not easy, right? Like when you go to the builder and you're having the conversations and they've heard about these things and they say, well, we like the service that you give. We'd like to have a lender, we just don't know how to do it, but you're really good at it. How about we form a company together? And you say, that's fantastic. So the first thing we do is each of us put $500,000 into this new company and we start the process. It's a real investment, and they need to be able to understand that this is not just, you toss in a couple $1,000s and you're off to the races. It just doesn't work that way.
Yeah, it's a big investment, and you have to wait for that investment to come back, and it will take time. Yeah.
It will. I mean, it's a legit company, right? If it's done in a legal way. And it can't be what I like to call it. It can't just be the lender in joint venture clothing. It's got to be an actual independent entity that, again, it looks and feels like every other entity out there. Now, there are some ways that, especially in the early days as a startup, that the parent companies, the builder, for example, on the one hand, or the realtor on the one hand, and the lender can, provide some support, some guidance. You can provide some services, like the company might rent office space from the builder partner, or it could also rent office space down the street and not rent from the builder partner. It could get, for example, even if it's a correspondent lender, can get underwriting services from its lender partner, or it could go get underwriting services from some other provider of underwriting services. And they just need to make sure that if they are going to lean heavily on the owners, these partners that own the joint venture, they need to make sure that, again, just like regular RESPA that we talked about at the beginning, it's services that are actually needed and services that are fair market value payments for the services actually received. So if you're paying regular underwriting fees just like you'd pay to the MI, you're probably in pretty good shape. Should that company be trying to get its own underwriting going over time? It probably should, right? Just like any lender, probably should be growing and trying trying to become a completely independent lender, but there's no written guidelines.
Yeah, you start with some LOs, and then but you need to get your processing into there, and then continue to grow so that it continues to be its own company. But like you said, they can outsource to one of the owners or a sister company affiliate. But that all needs to be in a service agreement. I mean, you have to have fair market value. You have to actually pay for those services. And there's a lot of services that go into a new company. What about your accounting? You got to set up some new bank accounts. You got separate staff. You have warehouse lines. You have vendor management. You have a whole slew of vendors that the joint venture will need. Credit reports, your doc vendors, MI, your loan origination system. You've got your facilities, like you said. Are you going to rent some space from one of the owners? But again, fair market value. You have to prove the amount. You've got your HR, your IT. There's a lot of areas that go into having a company that you have to consider. You can outsource for sure to one of the owners, but you need to document that and pay the fair market value for that.
That's right. That's right. And what the challenge will be a lot of times in these situations when regulators come in and they talk to people is that they'll say, isn't this really just a scam? I mean, that's what their first thought is anyways, right? Isn't it really just a scam? It's really just a way for this lender parent to set up this sort of fake company so that the realtor can, or the builder can refer business to the fake company, and then the realtor or builder owner gets half of the profits, but really it's just a referral fee. That's what you're fighting against. So you gotta have, the company has to have its own management, has to have its own employees. It doesn't have to be a big company. There are lots of small companies out there, but it's gotta act and operate like a regular company.
Yeah, and they need to do plenty of loans. I mean, it's not just referrals from the other owner. It's not just referrals from that builder or from that real estate agent. You are your own company. You are a lender. So you need to be able to do loans. Like if any borrower walked in off the street, said, "Hey, I like your sign. I want to get a loan with you." Well, do a loan for them. It's not just based on your ownership and who owns, the other owner, the other partner.
That's right. So we can go on, Paula, but I see the time, and maybe we want to break for some questions. Yeah, it goes quickly, right? Maybe we want to break here for some questions, and we can talk about whatever people want to.
Yeah, if anyone has any questions, you can post those in the Q&A dialog box, and I'll be happy to pose those to Troy and Paula. So I'll give people a few minutes to ask some questions. I will share with everyone, which I should have at the top of our webinar, that we are recording this this presentation, and it will be available on our website, probably I would say by tomorrow, if not early next week. So you can either take a look at some areas that you want to review again, or share it with a colleague in your office or in another company that might want to have this, have this information. And thank you guys for a great presentation. As speaking as someone who does not do this for a living, I can tell you that the notion and the questions around marketing service agreements has been around for quite some time, and it does seem to be an area that's always a good, it's good content to revisit on a regular basis, because you say, I mean, there's lots of ways that you can kind of run afoul of a good compliant, arrangement. So I think this was a really timely presentation. I will again continue to monitor if there's any questions that are being posed, and we'll share that with you. So we do have one. Let me open this up. Should lenders have purchase and sale agreements between the lender and the JV?
Yeah, they should. So assuming there is going to be, assuming that joint venture company is going to sell loans to its parent company, then you need an agreement, because you're going to need to be able to establish that what the terms are, that the terms are fair, that the terms are fair market value, and that will, that's what any other lender would be doing. And in addition, that NewCo JV company probably should be looking for other investors or relationships too. So you can sell loans to your lender parent, but you should probably try, just like any other company would, try to go get an agreement to sell loans to whoever, to some other investor, whether it's one of the big aggregators or somebody else. It should, again, look and feel like a regular company.
Okay, all right, thank you. Next question. If you have a detailed service agreement, can you outsource your compliance department to perform compliance activities for the JV?
So, yeah, Paula, do you want to take it? I'm happy to chime in.
Yeah, I mean, you would know the legal side of how that agreement should be prepared, that's for sure. And that's where you bring your legal in. But yes, you could outsource. I think the difficult part could be how do you determine the fair market value? And you may want to base it off of how much time your compliance needs to spend. It could be based off timesheet and how much are those people paid. But I think that's part of the most difficult is determining that fair market value and making sure that that's charged to the joint venture.
And I think that one of the touch points where you can find that, first of all, you don't have to use your parent, right? You could, but you don't have to. I mean, Jeff's on the phone here. You could go to a company like his, and they offer outsourced compliance functions, I'm sure. And Ray Snitchable, also on the phone, his company as well. They offer these types of services. So you can either use a third-party service like that, which makes you feel and look more independent, of course, or at least if you're going to outsource to your own particular owner, then at least there's a marketplace out there that can be kind of a guide for what types of costs that might be worth.
Okay, next question. Can a JV utilize the parent lender's lending and compliance policies and procedures?
They would need to have their own policies and procedures. So they need to tailor them to their own company. Every company needs to tailor their policies and procedures to what they do. What programs do you offer? What are your business functions? So you do need to tailor them to the joint venture.
I think this is one of those areas, that's a great answer, Paula. And I think it's one of those areas where the other partner, so the builder partner or the realtor partner, they're really looking to the lender partner to guide them, because they don't know what this business is about. That's why they come to you. Otherwise, they just set up their own company themselves and do it all by themselves. They don't need you. And so I think the lender partner, if it's the size that it's thinking about JVs in the first place, probably is pretty substantial. And I don't know how many employees, for example, are at CMG, Paula, but my guess is it's a pretty substantial amount. Well, if you took some of just take any one of the policies, your compliance policy, push that down to your joint venture company, there's going to be a lot of infrastructure there that the joint venture company, if it really looked and read that document and tried to implement it, they'd say, what do you mean there's a compliance committee meeting every Monday? I'm a loan officer. That's all I am. What am I going to do with this? So it really has.
Who is the BSA AML officer?
That's right. That's right.
They need to tailor it to the actual company. Who is that officer? Yeah, exactly. It's different. It does change.
So our next question, would a broker JV need to charge for underwriting?
So a broker typically wouldn't be underwriting. So now it could be a lot more complicated than that, really. But if it's a broker JV, again, they come with a little more risk because they're lightly capitalized frequently and have less people, they look less substantive. You get more challenges from a regulator. But it doesn't mean brokers are illegal, it just means they're more risky. But a broker would be just like any other broker typically. So they take the loan application, they do some services on the front end, but then they send the package off to the wholesale lender, which could be the partner who owns them, or it could be some other wholesale lender as well. And I would suggest you have more than one.
Again, don't be exclusive.
Right. Okay. All right. Well, I think that concludes our questions. And again, great presentation, Troy and Paula. Thank you so much. I want to just make an announcement for next month's webinar. We'll be talking about fraud trends in the COVID environment. And we have Adam Chaudhary from Fending Shield, Pamela Flexer with LoanPal, and Krista Greco from the FBI Mortgage Fraud Division. So look forward to that, that conversation next month. Thank you all for joining us today. I hope you have a great Memorial Day weekend, and we will see you next time.
Thank you. Really enjoyed it. Take care, everyone. Have a great one.